Welcome back to the deep dive. Today we're digging into the essential services sector, specifically waste management, collection, recycling, that whole complex world.
And we're looking at a really interesting situation, almost a paradox.
Exactly. How does a huge company in this space deliver what they call strong results, boost profit margins, when they're also facing, and this is their term, persistent headwinds? In big areas like construction,
Yeah,
manufacturing.
it looks like they're rowing upstream, against a sluggish economy.
But somehow managing to, well, outperform significantly. It's quite the puzzle.
It is. And we're pulling this from Republic Services' third quarter 2025 investor call, the transcripts, the filings. Our mission today really is to get behind those headline numbers.
Yeah, figure out what's really driving this.
What's sustainable, long-term strength, and what might be, let's say, more temporary, maybe one-off boosts.
Okay, so let's start with those headlines because the numbers, they do look pretty strong, especially given that weak macro picture you mentioned.
They really do seem to defy the environment. So overall revenue growth reported at 3.3%.
Okay.
But the real story, I think, is in the profitability. Adjusted EBITDA growth, that hit 6.1%.
Which is quite a bit faster than revenue growth.
Exactly. And that translates directly into margin expansion. Adjusted EBITDA margin, it expanded by 80 basis points, a very strong number.
80 basis points, so almost a full percentage point improvement in profitability.
Yeah, bringing that enterprise margin up to 32.8%, that's really quite high.
That signals some really tight execution, doesn't it?
It does. And then you have adjusted earnings per share, EPS, reported at $1.90. And their year-to-date adjusted free cash flow. Well, that's sitting at $2.19 billion.
$2.19 billion. So the cash generation is clearly very strong.
Phenomenal.
But for you listening, the big question is, where did this performance actually come from? Was it smart strategy, disciplined execution, or maybe just a bit of luck with circumstances?
Or a mix of all three, right? We need to unpack it.
Let's start with the challenges, the headwinds they explicitly mentioned, just so we appreciate what they're up against.
Right. Management was clear. They achieved this even with persistent headwinds. So if you look at the core collection business, there was definite volume softness.
Okay, where specifically did they feel that weakness?
Mainly in the industrial-linked areas. So collection volumes declined, driven by that continued softness in construction and manufacturing end markets.
Makes sense. Less building, less factory output, less waste.
Exactly. When construction slows, you just don't need as many dumpsters or large-scale removals. They also mentioned residential volume was down slightly.
Oh, okay. Why was that?
Well, they framed it as a strategic choice, actually, shedding some underperforming contracts.
Yeah.
So kind of pruning the business, focusing on margin over just pure volume growth there.
Interesting. Prioritizing profitability, and then there's always recycling, right? That commodity market volatility. Was it a help or a hindrance this quarter?
Oh, is a massive hindrance, a real anchor, as you put it. Recycling commodity prices, they averaged only $126 per ton in Q3.
Wow, that's low compared to what?
Well, compare that to $177 per ton in the same quarter last year.
Ouch.
Yeah. So that price collapse in recycled materials, it created a direct 20 basis point headwind on their adjusted EBITDA margin. That's a direct hit to profitability just from lower commodity prices.
Okay, so we've got lower volumes in key areas and recycling prices dragging margins down, but they still ended up with an 80 basis point expansion overall.
Right.
So the offset, that jet engine I mentioned earlier, it must have been pricing power.
It absolutely had to be. Pricing was the critical shield here. It definitely offset the pressure from both the weak volume and that commodity crash.
What do the numbers look like there?
So average yield on their total revenue was strong, 4.0%. But the number that really stands out, the one that highlights their market strength, is the core price on related revenue.
Okay, let's pause there. Define related revenue for us because that distinction seems important.
Yeah, good question. It basically strips out the more volatile parts of the business. So it excludes the commodity revenue from recycling and also the environmental solutions segment, which we'll get to later.
Got it. So it's the core collection and disposal services.
Exactly. And on that related revenue, the core price increase was 7.2%.
Whoa, hang on. 7.2%? That sounds incredibly high for an essential service. I mean, can they sustain that kind of increase? Is there pushback?
Well, it certainly suggests very strong demand inelasticity, doesn't it?
Sure.
Especially on the commercial side. And they broke it down further.
Okay.
Core price on small container services was up 9.2%. Large container, 7.1%. And even residential pricing was strong at 6.8%.
9.2% on small containers. That's significant.
It is. These look like very disciplined, targeted price increases. Management credits their ability to price consistently above their own cost inflation.
So pricing is clearly the hero of the story. Was there anything else propping up that margin, operational stuff?
Yeah, absolutely. They definitely flagged disciplined operational execution.
Yeah.
Cost management was key. And they specifically mentioned labor productivity improvements.
How much did that help?
They cited a 70 basis point improvement in labor as a percentage of revenue. So labor costs grew slower than revenue.
And how'd they achieve that?
They directly credited their digital operations platform, things like route optimization, better scheduling, basically needing fewer labor hours to service the routes. And that feels like a more structural, sustainable gain.
Okay, that sounds sustainable. But now we get to the asterisk, right? Because you mentioned some of this performance might have been, well, event-driven, not repeatable.
Exactly. This is crucial to understand the quality of the earnings this quarter.
So let's talk about those non-recurring boosters. What happened?
Well, remember we said organic volume declined. That decline was actually almost entirely offset by a really big spike in construction and demolition C&D and special waste activity going into their landfills.
Okay. And that spike came from?
Disaster relief efforts, primarily hurricane recovery.
Ah, okay, give us the specifics on that. How big was this cleanup boost?
It was significant. C&D volume specifically into their landfills increased by 35%. 45%.
Wow.
And they explicitly said this was driven by hurricane recovery, mostly in the Carolinas. That specific activity generated $35 million of revenue just in Q3.
35 million in one quarter from hurricane cleanup. Okay, zoom out. What did that mean for the year so far?
Year to date, combining hurricane and wildfire cleanups, the total event-driven revenue was approximately $100 million.
$100 million. Okay, that is definitely not insignificant. High margin revenue too, I'd imagine.
Very high margin, typically. Landfill revenue tends to be quite profitable. And management actually quantified the impact. They estimated this event revenue benefited the full-year adjusted EBITDA margin by about 30 basis points.
30 basis points. Okay, so if the total reported margin expansion was 80 basis points.
Right, nearly half of that gain, about 30 basis points, came from this temporary, non-recurring disaster cleanup revenue. That's the crucial takeaway here. Excellent performance, yes, but you have to mentally discount a big chunk of that margin gain when thinking about next year.
That context is absolutely vital. Okay, before we move off temporary factors, didn't they also have some labor disruption costs earlier in the year? Did that weigh on Q3 at all?
They did mention it. The impact was mostly booked earlier, but it's part of the year-to-date picture. They quantified the total financial hit at $56 million for the year so far.
56 million? How did that break down?
It was about $16 million in customer credits, which directly reduced revenue, and then $40 million in increased operational costs associated with the disruptions. Management said they believe they've mostly captured the full impact now, but, Q3's strong performance had to absorb that cumulative $56 million hit that was already on the books for the year.
Right, so pricing was the core engine, disaster relief was a temporary turbo boost. Let's switch to the segment that really struggled, environmental solutions, or ES.
Yeah, this was the weak spot in the quarter, no question.
It was the hazardous waste, special waste, field services part of the business, right?
Exactly. And the numbers were not great. Net revenue for ES actually decreased, and that decrease created a 140 basis point headwind to the total company's revenue growth this quarter.
So it dragged down the overall top line. What about profitability in ES?
That took a big hit, too. Adjusted EBITDA margin for the ES segment dropped pretty dramatically, down to 20.3% from 25.2% in the prior year. That's almost a 500 basis point erosion.
Oof, why such a sharp drop there? It's usually seen as a specialized, maybe higher margin business.
Well, management pointed to three main pressures. First, just that continued softness in manufacturing activity we talked about earlier. Less industrial output means less hazardous waste generated.
Okay, that makes sense.
Second, they saw lower event-driven volumes within ES itself. Things like less activity related to energy exploration and production, and also fewer big emergency response jobs compared to last year.
The third pressure had to do with costs, right?
Yeah, it's the fixed cost structure. ES operates specialized treatment plants, expensive equipment. When volume drops, those fixed costs get spread over less revenue, so the margin impact becomes, as they put it, more pronounced. It hits the bottom line harder.
Okay. Now, I remember reading something about an accounting item that made the year-over-year comparison look even worse. Can you unpack that?
Yes, that's important context. It was basically a timing issue around a non-recurring $6 million swing between the 2 years.
How did that work?
Well, this year, in Q3, they recognized a cost related to a legal settlement within the ES segment. Last year, in Q3, they actually booked a benefit from recovering some bad debt.
So a negative this year versus a positive last year.
Exactly. And that single $6 million swing, that difference year over year, accounted for about 140 basis points of the ES margin decline all by itself.
Okay, so while the market conditions were genuinely tough for ES, that nearly 5-point margin drop wasn't all operational. A decent chunk was this accounting swing.
Precisely. It amplifies the underlying weakness, but it's important context.
So given these challenges, what's the outlook for ES? Are they pulling back?
No, not at all, it seems. Management kind of framed it as a cyclical trough. They actually noted that demand seemed to stabilize as they exited Q3.
Oh, interesting.
And they mentioned they're building a strong pipeline of new business. So looking ahead to 2026, even if the overall macro environment stays a bit sluggish, they are actually planning to forecast growth in environmental solutions. They still see those assets as really crucial long-term.
Okay, good context. Let's pull back then and pivot towards the future, the long-term strategic stuff. Where's that big chunk of free cash flow, that $2.19 billion actually going?
Right. This is about building the next phase of growth. And the focus is clearly on sustainability-linked investments. Two big areas, plastic circularity and decarbonization.
Let's take plastics first. The
Yeah.
polymer centers. What's the latest there?
They're making real progress. Commercial production actually started at their Indianapolis Polymer Center back in July.
Okay, so that one's up and running.
And the Blue Polymers joint venture facility, which is co-located and does further refinement of the plastic, that's expected to start commercial production late in this current quarter, Q4.
And are they still confident in the economics of that? It's a big investment.
Yeah, they reiterated that despite the ramp-up challenges, they believe the long-term value spread, the difference between the cost of the input plastic waste and the price they get for the high-quality output pellet remains very strong.
Okay. Then the other big bucket is decarbonization. Renewable natural gas, RNG, and electric vehicles, EVs.
Huge investments here. On the RNG front, where they capture landfill gas and convert it to pipeline fuel, they brought another project online in Q3.
How many does that make for the year?
That makes 6 projects that started operations in 2025, and they expect to get a 7th online by year-end. So they're really building out that portfolio quite aggressively.
And the EV fleet transition, that's not just buying trucks, right? It's infrastructure.
Oh, completely. Huge infrastructure. They said they now have 137 electric collection trucks in operation. The target is over 150 by the end of this year.
But the charging.
That's the big piece. They now have 32 of their facilities equipped with commercial-scale EV charging infrastructure. So, yeah, it's a massive capital-intensive overhaul of how their logistics work.
Okay. Beyond those big sustainability plays, where else is the capital going? They generated a lot of cash.
It's really a dual strategy they're pursuing. Growth through acquisitions, M&A, and returning cash to shareholders.
How much on acquisitions?
Year to date, they've invested over $1 billion in acquisitions, both in the core recycling and waste business and in environmental solutions. So M&A is clearly still a major part of the growth plan.
And shareholder returns.
Also significant. They returned $1.13 billion year to date through dividends and share repurchases.
And didn't they mention ramping up the share buybacks specifically in Q3?
They did, yeah. They framed it as being opportunistic, seeing the stock price levels as, quote, a great opportunity to create value. So basically signaling they thought their own stock was a good investment, investing externally via M&A and internally via buybacks.
Okay, so let's try and synthesize this. Q3 2025, it was a complex picture.
It really was. Kind of a tightrope walk as I think about it. You had this incredible core pricing power, which was absolutely the engine, no doubt about it.
Right.
But that strength allowed them to do several things. Overcome those macro volume slumps we talked about, absorb the big commodity price headwinds, and benefit significantly from that temporary high-margin disaster cleanup activity.
Which brings us right back to thinking about 2026.
Right.
Because this year's performance, while strong, sets a really high bar for comparison, doesn't it?
It absolutely does. Management was very direct about this. Their long-term goal, or algorithm as they call it, is still intact. Mid-single-digit revenue growth with EBITDA growing faster than revenue. But they explicitly warned they'll be coming over a tougher comp in 2026. That $100 million in non-recurring, high-margin disaster revenue from this year, 2025, that's just not going to repeat.
So anyone analyzing their growth next year has to factor that out.
You absolutely have to mentally adjust for the non-repeat of that windfall. Those the underlying growth might look weaker than it actually is.
So the core business sounds healthy, growing through price, M&A, efficiency gains. But the headline growth number next year might look a bit depressed simply because 2025 had this unusual boost.
Exactly. That's the key nuance.
Which leads us perfectly into our final provocative thought for you, the listener. Despite all this complexity, the financial maneuvering, the huge spending on electric trucks that cost maybe $400,000 each, the $50 million recycling centers, the perpetual care needed for landfills management made a pretty bold assertion.
Yeah, what was that?
They suggested that on a macro level, this whole essential services industry might actually be fundamentally underpriced.
Underpriced, even with those 7-9% price increases we saw.
Apparently so. The point they made was fascinating. Think about a residential customer. What they pay for their weekly waste collection and disposal service
Yeah.
is often less than what they might spend on a single monthly subscription, like for coffee or a streaming service.
Huh. When you put it like that.
Right, but the service being provided, managing this complex, expensive, essential infrastructure, is vastly more involved and capital intensive.
That's a powerful point. The perceived value versus the actual cost and complexity of delivery.
Exactly. And it suggests that maybe, regardless of the ups and downs of the economic cycle, there could still be significant underlying pricing opportunity left in this industry for years to come, simply because the core service might be undervalued relative to what consumers pay for other things.
Yeah, so it certainly makes you think differently about the value of just having your trash taken away each week
Yeah.
and the massive system behind it. A really interesting thought to leave things on.
A deep thought indeed. Thanks for joining us for this deep dive.
Always a pleasure.